Get the video. Okay. All right. Welcome everybody. Welcome to the fourth class. Believe it or not, um, the last tutoring class that they did back in September 2022 have only 5 classes. Okay, and each class is like about 2 hours, 3 hours long, right? And it's on a faster pace than this one. Okay, so this one I cover more, so the number of classes is going to increase. But I provide more details in this class. Okay, hope that when looking at the look back at the slide decks as well as a video, it will trigger your nerve, your brain. Okay, bring back some of the material that I discussed in the class. And also, I need to be organized the material a little bit so that I'm not only tell you about the law, the act, but I need to tell you what is it affect and why it was introduced and how is that applicable to the transaction that you going to support or the loan officers supporting the buyers, right? Or the borrower. So that way, you see how each act, each law applies in real time. Okay, and also because my goal is that not only helping you, teaching you and helping you pass the test, I also want to teach you how to become a loan officer, right? Practically, right? Because once you pass the test, you're gonna be swimming in a big ocean, a big open ocean, right? Because nobody gonna hold your hand and then teaching you and then guide you through. It's gonna take you months and years before you master or get a hold of the loan origination activities. So that's why my explanation, I'm using some of real world situations so that you can see how everything works. Okay. And I also, because I'm a realtor too, right? So I'm also explaining the real estate side. So you're going to see that how is the loan officers interact with the real estate side. Excuse me. All right, so let's go ahead and begin. Okay, so we're going to skip a couple slides here. So today's the fourth class. After today, I'm planning to take a week off. Uh, but don't buy into that, because like if I able to prepare any material, I may send out an email and then we can have a class too, because I want to wrap this class as soon as possible so that you can start your journey, take the online course. The thing is that even if I have a skip a week, right, you try to finish your online class if you are taking it. Okay, because the class that you register maybe only 10 days or 14 days. You need to complete that first, right? But you don't have to take the test yet. Just follow my class, and eventually I'm going to have a prep class. I'm going to teach you go over all the questions, possible questions for the test, right? And I'm going to point out strategies and how you're going to use to to do the test and pass the test. Okay, so follow with me. Okay, so this slide deck, this slide is the same as the last time. Okay, these laws are the same. Okay, so today we're gonna cover about TILA. Last time we actually did talk about TILA, right? TILA is about Truth in Lending Act. Okay, Truth in Lending Act meaning that you have to be transparent, right? You have to disclose. You have to do everything the right way. Even the marketing, the advertisement, everything need to be clear and truthful, right? So today, I'm talk a little bit more about another topic that related to TILA. Okay, and today is going to talk about the loan originator compensation. Okay, think about when there's something get involved with the money, right? There's always issue with that, meaning that the profession, right, the professionals, like sometimes they don't do the right thing. Okay, they do illegal thing. So that's why the compensation is one of the hot topic, right? You need to stay on course, right? You need to do the right thing, right? You don't want to get off track, right? Follow the law, do what the law tells you to do, right? Don't do anything illegal. Otherwise, you're going to get in trouble, get penalties, get imprisoned, or things like that. Okay. So, so what is a LOCOM or loan originator compensation? Okay, this is a rule that was introduced in 2014. So imagine that, right? 2008, 2009, where the subprime hit, right? The lending got hit the big time. The real estate market crashed big time, right? The reason that it's crashed because like there was no rule that guiding the mortgage industry. So that's why we started beginning of 2010. There's a lot of law coming out. I remember it was under President Barack Obama, right? And they introduced a lot of law during that time. And up until 2014, they come out with this loan originator compensation rule, which is a Reg Z, right? Regulation Z. And then all the loan officer need to follow and obey. Okay. So what is the LOCOM, which is a loan originator compensation, referred to the financial arrangements, and incentives provided to individuals or entities responsible for facilitating and originating mortgage loans. Loan originator compensation can take various forms, which including commission, origination fees, use spread premium, or salary, or even salary plus bonus. Okay, so when we're talking about a commission, right? Many loan originator earn the money, earn the income through commission, which is a percentage of the entire amount of the loan. Okay, and like I say, sometimes it's because like you get a compensation, you get a commission, but you also have to share that commission with the broker as well as paying the loan for the loan officer, loan processor, right? So that's why compensation and commission is part of your job. You got to close the loan to get the commission, and the commission is paid by the lender, or sometimes paid by the borrower. Okay, and it's based on the successful closing a loan or origination and closing of the loan. Okay, origination fees. Okay, what are those? Loan originators may charge borrower an origination fee for their services. This fee is a one-time payment, typically expressed as a percentage of the loan amount, and cover the costs associated with processing the loan application. Okay, a lot of this is actually charged by the broker. Okay, and because like there are some loan that including the fees for application fee, processing fee, and there's several more fee that that the origination is included. Okay, and yield spread premium, which is YSP, is a form of compensation that lenders pay to brokers or loan originators for originating loan with a higher interest rate than the borrower qualified for. Sometimes this is like in probably last class we mentioned about steering, right? It mentioned about steering the client from getting a good loan to a higher cost loan, okay, or a loan with a higher interest rate, right? That could be illegal, but right, there are certain programs that allow or giving the borrower the flexibility. So, for example, right, there's a program A to offer to the borrower. Say, okay, if you take program A, you're gonna get the interest rate of 5%. Okay, and you probably only pay $500 in fees. Okay, but there's also another program B, right? Offer you a higher interest, like a 5.25 instead of 5, but it's a 5.25. But the lender give back 1,500. Okay, instead of you take a 5%, you take a and pay 500. Now the lender, if you take 5.25 and the lender give you back, 1,500. So meaning that you can pocket 1,500 if you go with, 5.25. And sometimes they want to take that deal, that loan, so that they have some money to pay for all the costs. And it's legit and it's good, right? It's legal. Okay. And sometimes that the even the lender, right, behind the scene, the lender say, okay, if you sell this loan, right, we're gonna give you, let's say, $4,000, to the broker, to the loan officer. And sometimes the loan officer is nice enough to pass that credit, a portion of it, of the full amount, to the borrower, right? So that help the borrower with paying the closing costs. Okay, closing costs is including all the escrow processing, including the purchase, within the purchase, right? Like an escrow fee, inspection, appraisal actually on the lending side, right? Loan processing, title, or anything, right? So that money can be used, within the closing costs. Okay. So salary, some loan officers, some originators, particularly the one that work for larger, bank or larger financial institution, right? They receive a fixed salary, or sometimes a combination of a salary and the performance bonus. Okay, so that's how they they got their compensation. Okay, and sometimes loan originator can also get some additional bonus if they sell the loan in volume. Okay, and they if they meet a certain criteria, they're gonna get some compensation by the broker when they originate the all the loans. Okay, upfront fees. In some cases, loan originator may charge borrowers upfront fees for loan application processing, for credit checks, or any other services, right? Thinking about this, there's an issue, in the lending side, that the buyers, the borrowers, sometimes they don't go with one particular loan officer, right? They go around, they shop around for the best and better rate. And every time they doing that, right? Sometimes before they even lock in the transaction, or right after they lock in the transaction, but before closing an escrow, right? They shop around. They say, "Oh, I found this loan officer give me like a 5%, right? With zero zero fee. That meaning that they don't have to pay fee." So also imagine this, right? When someone say there is zero fee, it's not entirely true, right? There are always fees, but because like if you pay for the fee, you may get lower rate. If you get zero, you don't pay for the fee, then you get a higher rate, right? That's important that when you go out there and you market your product, try not to including the phrase say zero cost, zero fee, or free, free cost, because that against the tiller. Get that? Because the thing is that, like I say, there's nothing free. Believe it or not, there's nothing free. Because like you do the credit check, you have to pay for it. You do appraisal, you have to pay for it. You have the loan processor, you have to pay for it, right? All these are costs, right? If you take a lower rate, then you get extra credit that you can use that to pay for the for these fees. If you take a higher if a lower rate, then you have to so let's take it back. If you take a lower rate, then you're gonna have to pay for the fee. If you take a higher rate, the credit will help you pay for the fee. So that is nothing for free. Okay, keep a note of that, so that when you marketing the loan product, try not to say free or no cost, okay, or 0 point, or whatever it is. Okay, and guess what? Those marketing material need to be retained for 2 years. Okay, 2 years. If somebody, a year passed, somebody come back and say, "Hey, you market this product," and you say it's no free, no fees, no cost, but here are the costs, I'm going to sue you. Okay, so you got to be really careful of what you're doing out there, because I do see a lot of loan officer, doing that right now. Okay, they say zero cost, zero free, zero fee. Okay, and nothing here in the US is for free. One way or another, the borrower are going to have to pay for it. Okay, so be careful on that part. All right, so it is important that to note the loan originator compensation practices subject to regulation to ensure fair, ethical lending practices. Okay, the Wall Street Reform, Dodd-Frank, and the Consumer Protection Act introduced a regulation to prevent predatory lending practices and promote transparency in the loan origination compensation. Okay, these regulations aim to protect the borrowers by ensuring that loan originators do not engage in practices that could lead to loans that are not in the borrower's best interest. Okay, so remember that Dodd-Frank and Consumer Protection Act are the two acts that try to prevent the loan origination compensation, illegal activities. Keep that in mind so that it may be in the test too. I just saw a couple people just join. Let me drop again the slide deck for today. While I'm lecturing, if you have any question, stop me, because I am make sure that you understand what I'm teaching, so that way I can clear all the question that you may have, so that help you understand the material and help you pass the test. Okay, continue. TILA, loan originator compensation. Okay, MLO rule is issued by Consumer Financial Protection Bureau. Remember this acronym, CFPB. CFPB introduced this. Okay, so one of the way that when you study for the test, right, you need to know the government agencies, let's say in the mortgage industry, and make sure you know what this agency is doing. Does it like promote a law, a rule, or does it enforce something? Okay, so the CFPB is issue the MLO rule per the Dodd-Frank requirements. Okay, Dodd-Frank requirement is the Wall Street Reform Act. Okay, prohibit against dual compensation. Okay, dual compensation meaning that you cannot receive a compensation from the lender and also receive a compensation from the borrower. That is called dual compensation. Okay, this prohibit against a compensation based on the term of transaction or a proxy for term of a transaction, meaning that you cannot get the compensation, you cannot get the commission by selling a higher term, right, a higher cost, right? So that is what it's called, term of transaction. The amount of the originator's compensation for that transaction is not subject to change to offset the unexpected change in estimated settlement cost. What does that mean? It means that, okay, if the compensation is 1%, right? And whatever that in the loan estimate, the cost, the fees and everything in the loan estimate, and whatever in the final closing disclosure need to be kind of similar or exact. If you make a mistake, you put in the wrong cost, you cannot use your commission to paying off for that. Okay, and so that's what it means, right? You cannot use your commission to pay for those costs, the cost that you incorrectly put it in. Okay, and also to prevent incentives to upcharge consumer on their loans, prohibit profitability of a transaction or a pool of transactions. So there's sometimes that when you charge like an amount, right, and if you have like a big pool of transaction, then that is actually a big a big fee that you collect. Okay, and this prevent the low com is also prevent of that. Okay, but there are some exemption to this low com rule. Okay, The final rule permits a certain bonuses and retirement profit sharing plan. For example, the 401k plan, meaning that if you work for a company, right, sometimes you allowed to contribute your money into the 401k plan, or sometimes your bonus can be used to contribute into the 401k plan, right? Individual loan originator originate like 10 or fewer mortgage transactions during the preceding 12 months, okay? Let me see, what does that mean? The final version, bonus and retirement. I'm looking at number 2 right now and trying to make sense of this. Individual loan originator originated 10 or fewer mortgage transactions during the preceding 12 months. So meaning that if you don't originate a lot of transaction, right, you may not get the, I would assume that you probably not meet the number and you cannot get the bonus, right, or you cannot get the profit sharing. Okay, and the rule say you either get it or you don't get it. It's a flexible, right? It doesn't require that you have to get it. Okay, because like you don't meet the quota. Bonuses and other type of non-deferred profit based on compensation that does not exceed 10% of the individual loan originator total compensation. Let's say in the past 12 months that you make $100,000, right? Your additional bonus and compensation cannot greater than 10% of that amount. Like you cannot go over to like $111,000, right? You can reach the max 110,000. That's fine, but you cannot go higher than that. So that the compensation cannot be greater than 10%. Take a note of that. Okay. No prohibition on consumer payment of upfront points and fee. Okay, so meaning that some of the fee that they can the lender or the broker can charge up front, right? There is no limit to that. But the total overall also like take into account of the high cost and high price loans when it's the APR is over the limit. Okay. Apply to closed-end consumer loans secured by dwelling or real property that includes a dwelling. Okay. So it say that this MLO rule can be make an exception if it's like if it's a closed-end consumer loan. It meaning a closed-end meaning a loan that you will close, right? When you buying a real property. The rule does not apply to open-end home equity lines of credit, HELOC, or one-time or timeshare transactions. Okay, so the closed-end meaning you open a loan, okay, and then you're gonna close that loan, and you have like a individual payments, right? And everything is fixed. The open-end meaning that you have a line of credit that the rate may go up and down, right? And you are not fix that rate, that loan, until you decide that you're gonna want to fix it. When you fix that rate, meaning that you lock it in, then the amount of payment of each month until you pay off the loan will be the same, month over month. Okay, so that is called, when you have a fixed payment, that is called closed end. When you have an open end, meaning that the variable rate affecting your monthly payment. Okay, because the rate is go up and down, maybe daily, weekly. Okay, so your payment each month could be different, one month after the other. So that consider like an open end home equity line of credit, or timeshare transaction, right? I cannot recall how timeshare is worked in here because I never touch in with the loan for timeshare. Okay, Dodd-Frank Act requirements that loan originator provide their unique identifier under the NMLS. Okay, so we talk about this. Dodd-Frank require whoever originate the loan need to have an NMLS, ID. So that way, they know who originate the loan, and then the person and MLS ID will be on the loan forever. Okay, the LOCOM also, indicating that the record retention needs to be at least 2 years per the Reg Z. Okay, we're talking about this, yesterday as well, right? Record for compensation, record for commission needs to be retained for at least 2 years. Okay, why there is a LOCOM, right? LOCOM was introduced as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act, respond to the financial crisis in 2008. Some of the reasons including consumer protection, try to prevent a conflict of interest, make sure it's transparency, that the borrower will know everything that before they take on the loan, preventing predatory lending, right? Selling your high cost loan to somebody is unable to repay. Okay, make sure that borrower has the ability to repay. Okay, take a note of that phrase, ability to repay. And also, LOCOM was introduced to to provide fairness, right? LOCOM regulations seek to create a fair and level playing field among loan originators by ensuring that compensation practices are consistent and not based on steering borrowers into loan they may not be able in their best interest. Okay, and LOCOM also promoted because it's tried to promoting responsible lending. Okay, so we got the really good industry that follow the rules, follow the guideline and all that. So these are some of the reasons why the LOCOM were introduced by the CFPB, right? Consumer Financial Protection Bureau, right? Back in 2014. Okay, so far I have introduced to you like several laws and acts for lending, for mortgage. But right now, number 5, I'm going to introduce you to a real estate act, which is called Real Estate Settlement Procedures Act, RESPA for short. Okay, this was introduced back in 1974 for Regulation X. Okay, so when you heard about RESPA, right, you have to try to fit it into something regarding to transaction of a real estate or the process, the procedures in making that transaction complete, right? So the two terms in this whole phrase is settlement procedures. Okay, settlement meaning that this whole the transaction for real estate, it's a settlement that you purchase, you sell, you buy, and all that. Right? Regarding like buy and sell, disclosure, title transfer, and inspection, appraisal, all the shebang, right? Procedures are the step within those to guide it from the beginning to the end, right? So when you hear about RESPA, it's a Real Estate Settlement Procedure Act. It is a federal law in the U.S. that was enacted to protect consumers in residential real estate transactions. Residential real estate transaction. So RESPA only applicable to residential real estate. Okay, keep a note of that. It doesn't support. There's some exemption later or exception later. Okay, but keep in mind RESPA is only for residential. Okay, and it's not only for residential real estate transaction, it's also in the mortgage and settlement process as well. Because the RESPA kind of play in part for both mortgage and real estate. Okay, RESPA require disclosure. Okay, there are disclosure requirements. RESPA require lenders and mortgage servicer to provide borrower with various of disclosure at different stages of the loan process. Okay, so I mentioned about the mortgage servicer. Okay, what does it mean? What is it? What is the mortgage servicers, right? So we have a mortgage broker. No, let's take it away a little bit way back. We have a MLO, which is a mortgage loan originator. okay, which is a loan officer, and the loan officer working for a broker, right? A broker is like a boss or someone with a broker license that can brokeraging for different lenders, pick and choose different lenders to find a loan product to help the buyer or the borrowers, right? So we have a loan officer, we have a broker, right? And then we have a lender. Okay. Once we close the loan, sometimes the lender have a department. Let's say if this lender is Bank of America, right? Bank of America may have a department to service the loan. What does it mean by service the loan? Service the loan meaning that you send out an invoice, right? The statement every month, right? Say, okay, your payment for your mortgage this month, starting the first of the month, and if you don't pay by the 15th of the month, you're gonna pay late fee, right? If you don't pay 3 months in a row, you're gonna risk to be foreclosure, right? So the servicer or the department that helps service the loan gonna, at the end of the year, gonna send you a statement, a year-end statement, gonna tell you, okay, this year you pay this much principal, you pay this much interest, and you also have like a accumulation of the interest that you can use for tax purposes, right? And the servicer, right, they're gonna send you notice if you don't pay on time, you pay late and all that. So it takes all the burden of service alone, right? And that's I'm talking about a department within a bank, right? So there is actually a company that does the servicing. So you have a broker that work with a lender, and that lender doesn't have a department like a Bank of America, let's say, right? They hire a servicer to service the loan, to help with getting the money from the borrower. Okay, so that's what it is, a mortgage servicers, right? RESPA require lenders and mortgage servicers to provide borrower with various disclosures at different stages of the loan process. These disclosures including loan estimate, which provide the estimated of loan cost, the closing disclosure, the CD, which details the final loan terms and costs. These disclosures are intended to help borrowers understanding the term and costs associated with their mortgage loan. So disclosure is a must, and it needs to be clear, the numbers need to be right, so that the borrower, when they looking at the closing disclosure, which is a CD, they say, okay, I got this, I borrowed this amount on this rate, I pay monthly, there may be additional costs that I also pay within the loan, right? All that stuff is actually listed in the closing disclosure. Okay, it's also, RESPA also prohibit kickbacks. So when you hear kickback, that is for RESPA, okay? Kickback is for RESPA, right? RESPA preventing from kickback. Okay, what's kickback? You meaning, you give money to somebody that doesn't have a license, okay? And fee splitting. RESPA prohibit any kickback or referral fees exchange among settlement service provider, such as lender, real estate agent, and title company. So for example, right, I'm a loan officer, right? I have a client, right? I ask Mr. A, hey, I have a client. I want to refer my client to you, okay? In return, you pay me some referral fee. Okay, if I don't have the real estate license, that is illegal. That's violate the RESPA. Okay, RESPA doesn't allow kickback for the non-licensed, right? If I don't have a real estate license and I'm an MLO, I refer this client to the realtor, right? And I ask for kickback. I ask for referral fee. Or if I'm an inspector or if I'm an insurance agent, still I don't have the real estate license, or if I'm an escrow officer, right, and I refer client to a realtor and I ask for kickback and I don't have I don't have a license, then I'm violating the kickback rule by RESPA. Okay. However, if I'm a realtor, right, I have a real estate license and I have a client and I refer that client to another realtor, right? And I can ask, hey, I refer this client to you. I demand that you pay me the referral fee for 25%, 30%, 40%, right? And if the other side agree, then they pay me that within the escrow. Okay, within the process of the escrow of the purchasing. So that is legal, but it's documented in the escrow, right? And that is a valid referral between realtor and realtor, sell agent and sell agents. Okay, so for example, right? I have a realtor in Florida, and he has a client that want to buy a house in California, and they plan to move from Florida to California. So he reached out to a local realtor, and he found me. They say, "Hey, man, I have a client here that I want to refer to you, and my cost is 25% of your commission." Okay, I say, "Yeah, more than happy. I'll help you out." Right. So before he gave me the information of that client, he gonna write a referral agreement. Okay, in the referral agreement, both of the brokers of the two sides, because I work for a broker, he work for a broker, right? Both of the broker need to sign, and uh, and then they specify how much the referral fee is, right? And then after that, they fill in the customer information. So once everybody agree, I'm take this customer on, I'm have the customer close the home, I got the commission, I pay the referral fee to the other agent. So that is valid. Okay, but you cannot do any kickback for anybody that doesn't have a license. So especially if you refer a loan to another loan officer, okay, I don't let me think. I don't think that you even allowed to do that. Okay, RESPA is only applicable when you with real estate transaction. So if you refer a client to somebody, pretty much you don't get any referral fee in the industry, in the mortgage industry. Okay, but like I say, gotta be really careful about this thing. Okay, anti-kickback provision aim to prevent unethical practices that could drive up the cost of the consumers. Okay. Escrow account management. RESPA regulate the handling of escrow account by mortgage servicers. Okay, so we talked about the mortgage servicer earlier, right? So sometimes there is a situation that when you take on a loan, you pay for the mortgage each month. You're gonna have to pay the insurance, the property tax. Then those property tax you pay twice a year. So for those of you who don't know, right? Property tax you can pay in one lump sum for the entire year, or you can pay one on December 10th. Another one is on the April 10th. Okay. They the property tax they divide it into what is the term called? Two installment. Okay, two payment installments. The first payment installment needs to be due by December 10th. Okay, and usually the period of the property tax is July 1st to June 30th. Okay, July 1st of this year to June 30th of the following year. Okay, and for the first installment that due in December 10th is for July 1st to December 31st, or let me think. Yeah, December 31st, and then from that point on to all the way to June 30th. Okay, so it's more like a half of a year. So that's what it is, the property tax. And then the insurance. Sometimes that you pay the insurance monthly, every 3 months, or yearly. Okay, let's assume it's a yearly. Then in some cases, the borrower, does all the payment himself, right? But you can also set up an escrow account that each month, right, you do an automatic transfer into that account, including the mortgage of each month, the property tax, enough for 6 months that when the time due, right, that's enough money to pay for the property tax. the insurance like monthly, right? If it's a $1,200 a year, then each month, the servicer are gonna require you to pay $100 for the insurance, right? So the servicer are gonna take the budget or the fund from that account, from the escrow account, to pay for all these payments, or all these installment payments, right? So that's what it is. The escrow account is for. So it's all established guideline for the collection, disbursement, the management of the fund of the escrow account for property tax, homeowner insurance, and mortgage insurance premium. Okay, what is the mortgage insurance premium, right? Mortgage insurance premium, meaning that sometimes that if you go with a VA loan, a veteran affair loan, an FHA loan, because like you have a low down payment, right? Let's say you down 3%, let's say you down 5%, right? Until you bring your total, principal to 20%, then you don't have to pay for mortgage insurance premium. Okay. Otherwise, you're gonna have to keep paying for that, and sometimes it's cost you about $70 something all the way to $200, $300 a month. Okay, that is what it is. Until your down payment go up to 20%. Once it's past the 20%, you can call in to the servicer and say, hey, guess what? I just bring my total down payment or my payment, my principal all the way to 20% now. Let's cut this PMI, okay, or mortgage insurance premium. Okay, so that way you don't have to pay for that anymore, and that's going to reduce your monthly payment. Okay, anybody have any questions so far? Okay, next, good faith estimate. RESPA requires lender to provide a borrower with good faith estimate, GFE. Remember that. GFE is good faith estimate of closing costs within 3 business days of receiving a loan application. Okay, meaning that within the 3 business days, right, the lender need to provide a good faith estimate of all the estimate costs, right, to the borrower within the 3 business days after the loan application is submitted. This estimate helps borrower compare offers from different lenders. So now it's an open market right there, right? You have, within 3 days you get a loan estimate. You may still have enough time, doing your real estate transaction, that you may ask Mr. B, loan officer, to look at the land estimate and say, hey, can you give me a better rate? If that person they say yes, he may give you a different loan estimate, right? So earlier I was talking about the upfront cost that we as a loan officer, that sometimes we don't want to pay for the credit check. The client need to pay for the credit check, right? Imagine that if they keep jumping from loan officer to loan officer, within the first 3 days, right? Until they pick the right one, right? Every loan officer gonna ask for the credit check so that they can understand or better understand about the borrower financial situation by running a credit check, get a credit report, look at the credit report, and see what's going on, right? But in order to run that credit report, you need to pay for it, which is $35, right? Who's gonna pay for it? Imagine that if the loan officer pay for it, and then the borrower go to somebody else, right? So you lost $35 for no reason, right? So that's why you require the borrower to pay for it, right? Maybe if you have a good relationship with this borrower, you worked with this borrower in the past, and you know for sure that he's gonna stay with you, then yeah, go pay for it. Pay $35, right? Just try to help the process and keep it going faster, right? But keep in mind that $35 you don't want to pay for it. Let the borrower pay for it. Okay, so that is what is good faith estimate is. Good faith estimate was used in the past. Nowadays, after the application turn it in, you got a loan estimate, which is an LE. Okay, not a good faith estimate, but a loan estimate for conventional loan, FHA loan, VA loan, maybe non-QM loan too. Okay, conventional loan is something that meet the Fannie Mae and Freddie Mac, guidelines. That's what we call conventional. Sometimes there are loans that doesn't meet the guideline. We call them a non-qualified mortgage. The one that meet the Fannie Mae and Freddie Mac guideline is called qualified mortgage. The loan that doesn't meet the Fannie Mae and Freddie Mac guideline is called non-QM or non-qualified mortgage. Okay, so like I say, nowadays you're gonna receive a loan estimate, and then at the end of the loan processing, like 7 days before, or 5 days. Let me see, 5 or 7 days. I don't remember exactly. Before the close of the escrow, you have to send out a closing disclosure, a CD. Okay, and so now the term of good faith estimate is not used a lot, but guess what? It's still there, right? There's some loan that's still using the good faith estimate. I don't remember exactly which loan that is. Maybe some private private loan or something like that still use the good faith estimate. But majority of the loan programs, loan products right now is using LE and CD. LE is within the 3 days of the application, you have to provide a loan estimate. CD is, I believe, it's a 5 day before closing of the escrow. Okay, servicing transfer disclosure. Sometimes the servicer, or the lender decide to pass the loan the loan product to a different servicer, right? And then, or they sell the loan product, right? Let's say Mr. A borrowed this loan, so it's a product, right? We talked about the mortgage-backed security, like 2 days before, right? So they sell that to an investor, or they sell that to Fannie Mae and Freddie Mac for the second mortgage. Actually, not second mortgage. What is it called? Second market. I'm sorry, second market, right? Second market is investor, including Fannie Mae and Freddie Mac. So when you sell that product to somebody else, and that somebody else gonna have their own servicer. So now you have to transfer the servicing to that servicer, right? So, and when that happens, you have to disclose. So this is what it says: servicing transfer disclosure. When a mortgage loan is transferred or sold to another servicer, RESPA mandates that borrowers receive a notice at least 15 days. Remember this: when you transfer the servicer, RESPA required that the servicer need to send at least 15 days before the effective date of the transfer. This notice informs the borrower of the new servicer and where to send the payments. Okay, so the current servicer need to send out a disclosure to the borrower 15 days before that take place. And also the new servicer gonna send a welcome packet to the or email or mail to the borrower, say, hey, I'm your new servicer. Make sure that you send to this address all your payment, right? If you want to set an auto pay, all that, make sure it's go to this. Okay, so RESPA require that servicer to do that. Okay, information request right. Borrower have the right to request information about their mortgage loan, including loan history and escrow account statements. Servicer must respond to these requests promptly in the timely manner. Okay. RESPA Section 8 violation. Section 8 of RESPA prohibits certain practices such as giving or receiving anything of value in exchange for referral or settlement services violation, or Section 8 can result in penalty. So meaning that you cannot refer somebody some client and they pay you back on behalf of a favor or something like that, right? Try not to do that. Otherwise, you're gonna get in big trouble with RESPA. Okay. Anybody with any questions so far? Everybody's sleeping. Wake up. All right. I think it's a lot of information. So just listen me out. Okay. Then when you study, go back to my slide deck, go back to my video. Okay. That's my goal. Okay. Let's continue. Okay. We're still on RESPA. RESPA is the biggest, I believe it's the biggest act, for real estate and mortgage lending. Okay. So more, So on the left side here, I have a little note. RESPA is administered by and enforced by the Consumer Financial Protection Bureau, CFPB. Okay, remember that. Okay, let's continue. RESPA was enacted by the U.S. Congress back in 1975 to provide home buyers and sellers with complete settlement cost disclosures. So back in 1975, they used what? Good faith estimate. But I believe, let me guess, I think like maybe at 2010, right? When they amended the Truth in Lending Act, they changed it to loan estimate. And then they use closing disclosure. Okay. So RESPA was also introduced to eliminate abusive practices in the real estate settlement process. Okay. Any activity that going on in the buying and selling property, right? They try to eliminate all the abusive practices, including discrimination and all that too. Okay. Remember, RESPA prohibit kickbacks and limit the use of escrow account. Okay. So like I say, RESPA say limit the use of escrow account, meaning the escrow account can only be used to pay for mortgage, property tax, insurance, and maybe some of the mortgage insurance premium. Okay, not anything else. Not like your electric bill, your utility bill, your cable, and blah blah blah. Right? Imagine that if everybody opened an escrow account and put all that money in, and they use that money, they invest somewhere else. Then when they lost everything, then who's gonna pay for your thing, right? So also the escrow account is an account that you need to set on the side. You cannot commingling. Okay, this term is interesting. Okay, I'm introduced this term a little bit early, right? Commingling meaning that when a servicer or a broker have an account or an escrow account holding somebody else's money, you cannot put your company money in it. You cannot mix them together. If you mix them together, what they call is commingling. Okay, that is the no-no. You have to keep your company money separate, client or anything in the escrow account separate. Okay, on a separate bank account. Okay, otherwise you commingling and then you get in trouble. You get fined. You get penalty. All right. RESPA was also introduced to eliminate abusive. I think we already say that. Okay, enforcement initially fell under jurisdiction of the U.S. Department of Housing, Urban Development, which is HUD, right? After 2011, those responsibility for enforcement was assumed by CFPB. So right now, anything related to RESPA enforcement is by CFPB, Consumer Financial Protection Bureau, because of the Dodd-Frank Wall Street reform, right? The Dodd-Frank say, okay, we have to turn this enforcement from HUD to CFPB, and it was happened in 2011. Okay, and also Consumer Protection Act. Okay, so like I said earlier, good faith estimate of settlement cost, which is LE right now. Foreclosed and reverse mortgages, a loan originator is required to provide the consumer with a standard GFE or LE form that is designed to allow borrower to shop for a mortgage loan by comparing the settlement cost and loan term. So like I said, the goal of the LE or the GFE, right, is to let the borrower see what is the cost. It's more like a quote. Okay, the quote to borrow to get this loan is these costs. And then you take that quote, you say, hey, Mr. B, give me a quote on your side. And I'll take two quotes and then compare. Okay, which one is good? Which one is bad? Okay, which one is best fit with me? Okay, so in here, it's interesting that earlier I mentioned which loan is actually using GFE nowadays, right? That one is reverse mortgage. Okay, you can see right here. I have it here, right? Reverse mortgage is still using the term GFE. Everything else is mainly using loan estimate, right? GFE is just initial disclosure of the other costs. Okay, expiration of the original LE or GFE. If a borrower does not express an intent to continue with an application with 10 business days after the LE is provided, or such longer time provided by the loan originator, the loan originator is no longer bound by the LE. Meaning, the loan officer, give the LE out, and after 10 days, we're not going to honor that. Okay, if the rate going up, the fee going up, hey, too bad. We already give you 10 days. You didn't respond. You maybe shop around. You find another loan officer to help you. Now you come back because now my LE is better than everybody else, right? But guess what? It's already 10 days. I'm not going to honor that. I have to give you a new LE based on the current market today. Okay, so after 10 business days, you don't have you're not obligated to honor that LE, okay, or loan estimate. Okay, hopefully you catch that. Okay, GFE application requirement. What are required to get a GFE or loan estimate? A loan originator is not required to provide a GFE if before the end of the 3 business days. So meaning that whatever you do, the application open, right? You can wait until the last minute of the 3rd day, and then you give out the LE, or you can give out the 2nd day, right? But you is not obligated to give the loan estimate right away. Okay, so you can wait for 3 business days, right? Because sometimes the application can be denied, right? It's not for sure that this borrower able to get the loan, right? So you don't have to give out the LE just yet until you verify everything. And guess what? Sometimes the borrower take time to fill out the application, right? Until you get all the information back, you cannot give out an LE just yet because you don't know what the borrower situation is, right? You get all that information back, you type in the system spit out an LE. Okay, then you give that LE to the client. But if the client doesn't give you enough information, then you cannot do anything, right? And also you have to run the credit check too. Right? Okay. Okay. Let me see. Let me continue. An application can be in writing or electronically submitted. So in the past, most of the time that we do with writing, right? But nowadays that we're dealing with electronic, right? E-commerce, all that stuff, digital world, right? So we can apply and use the application online, right? Under the regulation, an application must include at least some of this information, or the following 6 pieces of information must include these 6 items, in the application. First is name, right? First name, last name, middle name, nickname, sir, LD of that. Gross monthly income, how much you get paid per month before tax. Gross monthly income. Your social security number, the property of the address that you're going to buy or you already got accepted. Okay, so when you fill out a loan application, that means you already get you already like the property, you already submit an offer, and the seller is already accept your offer, right? So that's why number 4, you need to have that property address. An estimate of the value of the property. Okay, an estimate is the amount that you offer for, right? You offer the home for 700. That's an estimate, right? And that estimate may bind if the agreement between you and the seller, right? However, during the process of transaction, you may renegotiate the purchase price, right? Most of the time it's going down, it doesn't go up. Once the offer gets accepted, right, the negotiation sometimes bring down the purchase price, okay, not going up. Okay, you can ask, you do inspection, right, and you find out issues. You need a roof replacement. The seller need to pay the solar system. If he doesn't pay it, he reduce the price. You pay for it. Okay, so there's a lot of things that you can negotiate during the transaction to bring down the purchase price. Okay. Number 6, a mortgage loan amount sound. meaning that, hey, I'm purchasing this home. I make a down payment of 20% for a $500,000 home, meaning I need a loan. Let's say 20% for 500,000. That's 100,000 down, right? And 100,000 down mean I need a 400,000, at least 400,000 in the loan amount. Why do I say at least? Guess what? Because there are additional escrow costs, mortgage fees and points and costs, right? So that's why I say at least. So if you down exactly $100,000, right, you may need, additional 5 or 10 grand more, right? So the amount of $400,000 may go up to 410,000, when the CD coming out, right? And because like you say you down 20%, then maybe you have to bring in, maybe instead of 100,000, maybe you may have to bring in 100,002, okay, to just cover the cost, okay. All right, and let me see, that's it. And in addition to a loan, originator may require the submission of any other information it deemed necessary, like employment, are you working, okay, your bank statements, right? You have any debt? If you have a debt, what is your payment? Give me your statement for your car debt, your student loan, right? All that information that you need, right? But giving out a loan estimate probably doesn't require a lot, right? And there's a lot of verification afterward that, throughout the process of, of the loan. Okay, good stuff, huh? Okay, more. Okay, RESPA applies to the majority of purchasing loan, refinances, property improvement loan. What is property improvement loan? Property improvement loan meaning that you may borrow a loan to renovate your home, okay? But ideally, realistically, that getting a loan for improving your home is happening during the purchasing, okay? Sometimes it's called rehab loan. Rehab means the home is so bad, right? I want to borrow the money to buy the home, plus some money to remodel and rehab the loan, and both of the loan combined into one loan, okay? So that's called property improvement loan. Sometimes, right, if you get I don't know if you heard about ADU. ADU is additional dwelling unit, meaning a granny slab, a granny house, right? And attach it, home, or you build entirely new structure in the back, right? So you can ask for a loan to pay for that renovation or addition, right? So that could also be become like an improvement to a loan, okay? Home equity line of credit. We talk about this, right? If you borrow the home 500 to borrow money to purchase a home for 500,000, you borrow 400,000, right? You down 100,000. Now the home is 700,000. You get at least $200,000 in equity, right? Plus your down payment, so that's like 300,000. And you can borrow an equity line of credit, which is an open loan we talked about earlier today, right? You get a line of credit, open line of credit, and you can use that money anytime you want. The the rate for that is actually up and down every day, right? Until you lock it in, you say, okay, the rate is 5% up and down, but now it's go down to 4.5. I'll lock it in for my $10,000 that I borrow to buy a refrigerator, for example. Okay. Okay, RESPA require lenders, mortgage broker, servicer of home loan to provide disclosure to borrowers concerning real estate transactions, settlement services, transfer of loan servicing, blah, 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 blah. Okay, all these services require the lender, mortgage broker, and servicer to send disclosures, all the associated disclosures. Okay, and I'll go more in detail some of the disclosure on the next few classes. RESPA prohibit loan servicers from demanding excessively large escrow account and restrict the seller from mandating title insurance company. Okay, so I talked about earlier, right? The escrow account only cover some of the payment, but not too much. Okay. A plaintiff has up to 1 year to bring a lawsuit to enforce violation where kickbacks or other improper behavior occur, right? So some borrower, so whoever doesn't like what's going on, right? They have up to 1 year to sue the brokers, the loan officer, servicer, lenders, right? They have 1 year, and anything that regarding to violation of kickback or improper behavior, okay, and you get 1 year. Remember that anything that I pointed out like that, it may be on the test. Okay, plaintiff has up to 3 years to bring a suit against their loan servicer. Okay, let me see. Okay, so earlier I included the servicer in the previous one as well, right? You have up to 3 years to sue a loan servicer. Okay, but anything that regarding to kickback or improper behavior, you have up to 1 year. Okay, RESPA has regulated mortgage loan attached to 1 to 4 unit residential properties only. Okay, I mark it, I highlight it, I bold it, right? RESPA only, cover residential 1 to 4 unit. Remember that. If it's, why is that 1 to 4 unit? Oh, I ask, right? Meaning that on the lot, on the land, you may have like a 3 units in there, or sometimes you build an ADU, right? An attached ADU, another ADU, a JADU. Okay, that's too much stuff, right? JADU. Oh, let me explain. JADU is somebody convert a garage into a studio. It's called a JADU. Attached ADU is that you have on the side of your home, you build additional room attached to it with full kitchen net. That's attached ADU. ADU is a separate unit on your land. Okay, it doesn't attach. Okay, so ADU, attached ADU, and JADU. Okay, 2 different things. Okay, so like I say, on a land, on a lot, you may have 3 units, like 3 attached, and then 1 separate. Okay, and it's only RESPA only protect 1 to 4 unit residential. Okay, RESPA requirement: disclosure to borrower any information about real estate transaction. The information disclosure should include settlement services, consumer protection laws, and cost of the real estate settlement process. So anything about the services of closing the purchase, it's called settlement services. Consumer protection law say, hey, this is a booklet, and these law protect you. Read it. Okay, the servicer and all this provide you those disclosure. And again, the cost of real estate settlement process. What are the costs when you close a loan, when you close the property in the escrow? Okay. Business relationship between closing service providers and other party connected to the settlement process should also be disclosed. So meaning that if the escrow company work with another company that help in this, they need to disclose, say, hey, I am affiliated with this company, right? Because sometimes somebody owning multiple companies, that that somebody owning, let's say, an inspection company, owning an appraisal company, owning an escrow company, owning a title company, right? But they can support one transaction, but they need to disclose, say, hey, we are all 4 of them. We work with all 4 of them. Okay, so that disclosure needs to be disclosed. Okay, affiliated business arrangement. Real estate broker cannot refer business to an affiliated title company without disclosing that relationship to their customer. So I just mentioned. The servicer is required to respond to the borrower complaint in writing within 20 business days. Keep it in mind. If somebody complains to the servicer, that servicer needs to answer that complaint in 20 business days. That complaining may be something, hey, your amount is not correct, right? You missed something, right? When you write to the servicer has 20 business days to respond. Okay, 20 business days excluding weekend and holidays. The servicer has 60 business days to correct the issue or give it reason. Okay, somebody complained it, somebody mentioned about something wrong. Within 60 days, you need to correct it or deny it by giving a reason. Okay, escrow account, I already say it, okay, must include 2 months cushion amount, okay, and cannot be greater than one-sixth of the estimated total annual payment of the account. Meaning that escrow account every month is have to have 2 months in there, right? So meaning that the servicer can use that money to pay for this month. After he paid for this month, hopefully in the next few weeks, that account will have enough 2 months payment. So that servicer doesn't have to go after you and say, hey, you haven't put money in the escrow account for the payments. So that account must have 2 months buffer or cushion in the account. And overall, the account total cannot be greater than the sixth of the whole year combined. Okay? An initial escrow account statement to the borrower as settlement is within 45 calendar days of settlement. So that the escrow account, right, that the servicer is managed, the servicer needs to send out an account statement within the first 45 days. Okay, we talk about transfer of servicing, right? The former servicer must provide disclosure at least 15 days before the effective of the transfer date. A letter from a new servicer must be sent within 15 days after the effective date of transfer, meaning the old servicer need to send out before 15 days of the start, and then the new servicer need to send maximum 15 days after that that new date start. Okay, payment not considered late during this 60-day period of transfer. Okay, because you transfer, sometimes that you don't get the memo, sometimes you don't get the new address, right? So you able to don't have to pay that money in the escrow account for 60 days. So that's why you need that 2 months cushion. Okay, remember that you have 2 months of cushion. So because like within 60 days, sometimes that you may be on travel, right? You may be somewhere that you don't get that notice, right? So you actually legally have 60 days if you miss the payment, right? But guess what? Right? If in the escrow account they have money in there, then that's okay. So this also saying that if there is a loan that doesn't have an escrow account and the servicer are transferred to each other, you still have 60 days too, regardless you have the escrow account or not. Okay? So you mean that you can miss payment, one payment. Okay, penalty and liability. Civil and criminal liability is provided for violating and prohibition against kickback and unearned fees. Okay, what are the penalty? You will pay 3 times equal the amount that you charge. Okay, for any services. If you charge it wrong, then your penalty is paying 3 times of that amount. The cost associated with any court proceeding. Okay, if somebody sue you, you pay for the cost for that, right? For the court, right? The lawyer and stuff, and other expenses. A fine of no more than $10,000, or put in a prison for not more than 1 year, or both. Okay, so if you violate it, the penalty will be you may pay up to 10,000. You may get put in jail for 1 year, or both. Okay, why RESPA? Why RESPA? Right, RESPA was introduced to, have a protect the consumer, get the disclosure of all the required disclosure, preventing abusive practices, make sure there's a fair competition, escrow account regulation. We talk about the escrow account several times, enhancing borrower rights, protect the borrower, right, and standardize all the forms. Okay, make sure all the forms are the same. Okay, and transparent in the servicing transferring. We talk about that. Okay, everything need to be clear and fully disclosed. Okay, so I talk about TILA, I talk about RESPA, and guess what? Now we have another TILA RESPA integrated disclosure rule. So these are additional rule for TILA and RESPA. And what is it called? TRID. Okay, remember this. TRID is a short-term word for TILA and RESPA integrated disclosure. Okay, interesting, right? I purposely want to introduce you to the TILA first, then I want to go over the RESPA. And now guess what? That that's two act, combine it into the TRID to provide additional regulation, additional protection, right? And that's TRID, and it was introduced in 2015, and it's Reg Z. So the TRID rule integrate with the mortgage loan disclosure required by TILA and RESPA and other disclosure required by Congress into the two disclosure form, including loan estimate and closing disclosure. So earlier I said that we no longer use the GFE, right? Good faith estimate. And I think the time that they stopped using the good faith estimate and introducing the loan estimate and closing disclosure, or LE and CD, is in 2015. Okay. The purpose of TRID, there's 7 goals for this. First, to facilitate compliance with the disclosure requirement of TILA and RESPA. Okay, compliance. To ensure that information about mortgages is disclosed to consumer fully and accurately, and to simplify the technical nature of the mortgage disclosure. Okay, disclosed, but it's refined, it's finite disclosure, and it's clear. Okay, to make it easier for consumer to locate key information, right? If you need any information about anything about the mortgage, about the loan, it's easy to find it. Okay, on the disclosures, to help consumer to compare the cost of different mortgage offer, right? So meaning you get the LE from Mr. A, you get an LE from Mr. B, you compare whoever best, you go with that person, or whoever you feel comfortable. Okay, to aid consumer in comparing estimate and actual loan term. So there you go, 2 LE, you compare to see if the term of which one is that you like. Okay, to aid consumer in understanding mortgages they are applying for, and to aid consumer in understanding mortgage transaction, right? The more information you get, the more understanding you get, and the more you make an informed decision, right? So disclosure helps, LE, CD helps, okay? To help consumer decide whether they can afford a mortgage. Now you get the CD, now you get the LE, right? Am I qualified, right? Am I able to make a payment, right? Because now you get all the information that you need. You make a wise decision. Okay, loans covered under TRID includes closed-end mortgages secured by real property, right? Closed-end meaning you open a mortgage, a loan, and you pay it fixed every month. Mortgage secured by 25 acres or more. Okay, so any loan that buy for land, but the land needs to be 25 acres or more, is covered under TRID. Okay, construction loan. Okay, vacant land loans. Okay, those are the ones that covered by TRID. The loan that not covered by TRID, including HELOC and reverse mortgage. Reverse mortgage are all seniors, all borrowers, right? Okay, keep going. What is the loan estimate? Right? We talked about this several times already. Loan estimate is to combine disclosure as discussed above by integrating the GFE and the early TILA disclosure. Okay, to provide like a more refined estimate for the borrower to see. The loan estimate need to provide within 3 days, business day after the application submitted. Remember that, 3 days, but after the application submitted. Definition, TRID rule define an application for these purposes, namely the consumers, okay? Definition, loan consummation. Okay, so when you, in the past, if you hear anything about consume a loan, or loan consummation, what does that mean, right? Understand this word and memorize it. Consuming a loan is not the same as closing or settlement, okay? Consuming a loan only occurs when the consumer becomes contractually obligated to the creditor on the loan, okay? Not, for example, when the consumer becomes contractually obligated to a seller on a real estate transaction. Okay, let me explain this a little bit clearer. Consumer loan meaning you apply for a loan, you close that loan application, you complete the process, and then you move to the next stage. You pay for the loan. That is, you consume that loan. Okay, is that clear? Right. So when you offer for a property, You haven't consumed that property yet. You haven't get any loan for that property yet, because eventually, who knows, you may fall out of that transaction. So when that happens, nothing going on. You're back to square one. But once you close the loan, once you close the transaction, when you are done with the refinance, that means you consume that loan. That loan become part of you now, and you make a payment to it. Okay. Closing disclosure. What is it? Integrated in the RESPA settlement statement and final seller disclosure. Okay. The creditor ensure the consumer receive the closing disclosure. Early on, I say, is it 5 days or 7 days? It's actually the lender need to send to the borrower the CD or the closing disclosure no later than 3 business days before closing. Okay, I was wrong earlier. Not 5 days, not 7 days. It's 3 days. 3 days before closing, right? The lender need to send out the CD. Okay. Okay. So here are some disclosure timing. 3 business days to provide all the disclosure to prevent closing delay on certain circumstances without triggering an additional 3 days. Okay. So anything that change, right? That roll over that 3 days of disclosure. If the loan APR becomes inaccurate over and above a specific tolerance level, the loan product changes and all prepayment penalty is added, and corrected closing disclosure must be issued with an additional 3 days. So any change that affected the CD, right? The CD need to be disclosed with an additional 3 days. Okay. All the changes to the disclosure that may be made without any additional 3 days period, but corrected. Let me say, but a corrected disclosure must be provided at or before loan closing. So sometimes there's some cases that just a minor change that it doesn't need 3 days, but the revised need to be provided at closing. Okay. Lender must provide a home loan toolkit to the applicant within the 3 business days of the application. So about counselor, about the home loan toolkit, that need to be provided 3 days after the application submitted. Okay. Okay. Furthermore, okay, these are some interesting stuff. 2 more slides. Okay. Hang with me. I know I'm a little bit run over because a lot of information, right? Trade establishes a tolerance or limit on the accuracy of certain costs. Costs disclosed to the borrower on the loan estimate and also on the CD. These tolerances are meant to ensure the cost disclosure to the borrowers are accurate and possible, and to prevent unexpected costs. Okay, so in the loan estimate and also in the CD, they listed like different kind of costs. Okay, some costs have some tolerance. Tolerant meaning that it can be changed, okay, or it cannot be changed, or it can only be changed for certain percentage. Okay, so meaning that whatever you tell on the CD, majority of the time need to be accurate, but some item can be changed. Okay, so here are 3 tolerance, 3 level of changes that you can apply. Okay, on the amount of each item in the estimate. Okay, some of the item meaning what? The point fees, the escrow cost, the escrow support fee, lender processing fee, blah, 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 all that kind of stuff. Okay, one day I will share you how the closing disclosure look. Okay. Okay, the TFE, good faith estimate, or the LE, tolerance rule generally place charged into 3 categories. First one, okay, anything that creditor charges for its own services, which cannot exceed the creditor estimate unless an exception applies. This is 0 tolerance. Okay, meaning that you cannot make the change unless if that is within the exception. Okay, I will go in more detail in the next slide. Changes for settlement services provided by a third party. Okay, like an appraiser, an inspector, for example, right? You can change, but the change can only be 10%, which is called 10% tolerance. and all the charges that are not subject to any limitation on increase or no tolerance limit. Okay, and I will go over that. Okay, next thing is annual escrow statement. For each escrow account, a servicer shall submit an annual escrow account statement to the borrower within 30 days of the completion of the escrow account computation year. So meaning at the year end, the servicer who managed the escrow account needs to send out a complete account statement, within the 30 years, within the 30 days, I'm sorry. The servicer shall also submit the borrower the previous year projection or initial escrow account statement. Okay, so I believe this is a last slide, but I want to go in detail about this stuff. Okay, this is supposed to be 1, 2, and 3. For some reason, they have 1 and 1 and 1 here. Okay, zero tolerance. What is it? Okay, for certain costs, there is no tolerance, meaning that the cost disclosed on the loan estimate must be exactly the same as the cost on the closing disclosure. So you have two paper. One is loan estimate, one is closing disclosure. Loan estimates is within 3 days of application open. Closing disclosure is 3 days before the close of escrow. Okay, and zero tolerance, meaning that the item mentioned on these two, some item mentioned on these two need to be exactly the same. They cannot be different. So that is called zero tolerance. And what are those? Fee paid to the lender or mortgage broker. If the lender or the mortgage broker say you pay me 1% fee, it's on the LE, that need to be on the CD exactly the same, no change. Number two, fee paid to any affiliates of the lender or mortgage broker. Say, okay, I'll pay for the appraiser $400 on the loan estimate. On the closing disclosure, need to be $400. It cannot be $600. Okay, and guess what? We talk about the compensation. What happened if it's actually different? Okay, the loan officer cannot take out some of his commission to pay for the difference. That's illegal. Okay, so somebody have to work on that and make sure that that cannot be different. Okay, fees for services that the borrower cannot shop for, but are required by the lender, such as appraisal fee. If these costs increase between loan estimate and the closure, the lender is generally responsible for covering the difference, not the loan officer. Okay, so like I say, fees for the service that the borrower cannot ask for, like appraisal, right? When you do appraisal, the lender gonna submit request an appraisal, and then the system will assign an appraiser. With that appraiser cost is, let's say, $400. That cost, if it's $400 in the loan estimate, need to be $400 on the closing disclosure. If there is any discrepancy on that one, then the lender gonna pay for it, not the loan officer. Loan officer is not allowed to take the commission to pay for the difference of the service that not picked by the borrower, but by the lender. Okay, so that clear, right? Zero tolerance, because like this thing for sure will be on the test. Okay, cumulative tolerance, 10%. Cumulative tolerance, meaning the tolerance between the loan estimate and the closing disclosure can be different, maximum at 10%. Okay. For some costs, cumulative tolerance up to 10% is allowed. This means that the total cost of this category on the closing disclosure can be up 10% higher than the total of those costs on the loan estimate, which include recording fees. Recording fee is the fee that the county is charging when you record a note or a deed of trust, which are the two main forms for a purchase of a home. Okay, fees for third-party services that the borrower can shop for and select from the lender written list. So let's say the lender have a list of servicers that provide some service to help with the transaction, and the borrower pick from that list, and the difference is maxed out at 10%, right? The loan estimate say 1,000, then the closing disclosure cannot go higher than $1,011. $1,101. I'm sorry. Okay, cannot go any higher than 10%. Right. Third, fees for services the borrower chooses that are not on the lender written list. So if the borrower picks some service, right, probably including, let's say, loan processor, perhaps, or transaction coordinator, for example, right? Those cannot be higher than 10%. Okay. Okay. If the total of these costs increase by more than 10%, the lender is responsible for it, not the loan officer, not the borrower. Okay. If any discrepancy, then the lender pay for it. Okay. Zero tolerance or no tolerance. Actually, zero tolerance I mentioned earlier, but this is no tolerance. Okay. Or variances allowed. So meaning that, there can be fluctuate between the loan estimate and the closing disclosure. Some costs have no tolerance, okay? No restriction, let's put it that way. And any increase is not subject to tolerance limitation, including prepay interest. Okay, prepay interest is like this. If the loan estimate say that you're gonna close on the 30th of the, let's put it this way. Your loan will close on December 15th. And then on the LE, say your interest that you're going to pay is from December 16th to December 30th. Okay. So that is the interest. And that may be equate to, like, let's say $700, right? Unfortunately, that the shifting of the closing of the escrow to December 25th, right? But now the interest that the buyer are gonna pay is only the 26th to the 30th, and that dropped down to $100 of the interest. So you kind of see that, that change, right? So there's no limit to that, right? Depending on when you close it, the prepay interest will apply differently. Also to the property insurance premium too, right? They they recalculate of that depending on which day that you close. So they varies, right? The amount placed into the escrow or reserve account. So meaning that you can put like 2 months buffer, right, into the escrow account, or right the lender require that you need to have 6 month reserve, right, into your checking account, your saving account. But now you put like a year reserve, that's fine too. Okay, so lenders are not subject to tolerance limitation for these costs, and they cannot change without restriction, meaning that lender will not pay for this, right? For zero tolerance and 10% cumulative tolerance, lender will pay for the difference. For this no tolerance, lender doesn't pay for it. And majority of this is that it's chained within the limit, which is the okay. So there's no need for paying. So last thing, why TRID? Right, TRID was introduced to enhance the consumer understanding, to standardize form, again, preventing any surprise costs like tolerance stuff. Okay, increase the transparency. Everybody know what it is, right? Including the borrower. Alignment with consumer protection goal, right? They want to have protection for all the consumer, right? Consistency in terminology, right? The thing that using on the CD, the LE, LECD, TRID, blah, 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 closure, disclosure, and all that stuff, right? The terminology is the same. Empowering borrowers, right? TRID empower a borrower to take an active role, right? You need to know what you do, right? And we help you by providing you all these kind of information. Reduction in documentation, right? By streamlining the documentation to simplify all paperwork and mortgage transaction, right? Fewer paperwork, everything is clear, right? There's no need to killing trees. Oof, I'm sorry, that's like 36 minutes over. Okay, so like I said, it's a lot of information, but I want to give you all the information that you could, and and I want to record it on a video on the slide deck so that you can watch it again. Hopefully, this session is good info. At least you see that some of the act, some of the laws, and how they work, okay, and details about each law and how they work together, right? everything is about focusing on educate the consumer, protect the consumer, and make everything clear to everybody. Okay, anybody have any question? Thank you for, tag along with me here. Anything? Knock, knock. Okay, Joe, anybody have any question? Hopefully the information is good today.
Yeah, that's good for sure. There's a lot of number, time, yeah, how to review it. Yeah, yeah.
Yep. Okay, so if you don't have any question for me, we're probably going to meet again after the first. Okay, I will see that if I have any free time between here, now and then I'm probably gonna host more, more session. If not, then I'll see you, in a week or after the after the new year. Okay. Any last question for me? And if I don't see you again, Merry Christmas and have a happy New Year. Okay. Enjoy your free the vacation time with your families. Okay.
Yeah.
Eat a lot of food. All right. Don't gain weight. Go
Happy
travel.
holiday. Today's
Happy
Friday as
holiday.
well. Yeah.
Yep. Okay, everybody. I'll see you again. Ciao.
Yeah. Thank you,
Thank
Anh Man.
you.
Yeah.
Okay, bye.